You've worked hard for decades. You've built your savings. Now the paycheck stops. What happens next will decide how your retirement feels. Most people think the hard part is saving the money. The real challenge is turning that money into income without running out. Pick the wrong withdrawal strategy, and you could lose years of financial security. Pick the right one, and you'll have the freedom to enjoy the retirement you imagined. Retirement is not just a bigger version of budgeting while you were working. It's a different game entirely. When you stop working, the flow of money changes. There's no salary to replenish what you spend. Every withdrawal is permanent. Your investments now have to serve two jobs. They need to grow enough to keep up with inflation. They also need to provide steady income to cover your expenses. Without a plan, you risk spending too much early. You could be forced to cut back sharply later. Or worse, you could run out of money entirely. A smart withdrawal plan gives you guardrails. It tells you how much you can safely take out each year. It adjusts when markets rise or fall. It balances today's needs with tomorrow's security. This isn't about chasing the highest returns. It's about steady, sustainable income. It's about keeping your lifestyle steady through bull markets and bear markets. Imagine two retirees starting with the same $1 million portfolio. One uses a structured plan that adapts to market changes. The other spends based on what's in the account at the moment. Over 30 years, the difference can be hundreds of thousands of dollars. The first retiree keeps traveling, upgrading the car, and helping family. The second has to skip trips, delay purchases, and cut back sharply. On the passive path, we focus on strategies that work in real life, not just the ones that look good in a spreadsheet. You're about to learn 4 of the most common withdrawal methods. Each has strengths, each has trade-offs. The key is knowing which one fits your situation and your personality. If you understand these options, you can build a plan you trust. You can spend with confidence. You can stop worrying about running out of money. You can focus on living. One of the simplest and most widely known withdrawal methods is the 4% rule. It came from research on how much a balanced portfolio could pay out each year without running out over a 30-year retirement. The original model assumed half stocks and half bonds. Here's how it works. In your first year of retirement, you withdraw 4% of your portfolio's value. If you have $1 million, that's $40,000. Each year after, you increase that amount for inflation. If inflation is 2%, you take the previous year's withdrawal and multiply by 1.02. The biggest strength of this method is its simplicity. It's easy to explain. It's easy to calculate. It can help you set a target for how much you need to save. If you know you want $40,000 per year from your investments, you can multiply that by 25. That tells you to aim for a $1 million portfolio. But this method has weaknesses. It assumes you'll spend the same amount every year. Real life doesn't work like that. Some years you'll spend more. Some years you'll spend less. It also assumes steady returns over decades. If you retire right before a market downturn and stick to the fixed withdrawal, you could lock in losses. Recovering from that can be difficult. Consider a couple retiring in 2008 with $1 million. The market drops sharply in their first year. They still take out $40,000 plus inflation. They're selling investments at low prices. Their portfolio may never fully recover. On the other hand, if they retired in 2010, they started during a long bull market. Their portfolio grew enough to support the withdrawals comfortably. This shows the danger of sequence of returns risk. The order in which you get your investment returns matters as much as the average return over time. The 4% rule works best as a rough guide, not a strict rule. It's a starting point for planning. It can help you estimate how much you need, but in real life, you may need to adjust your withdrawals based on market conditions. The advantage is knowing you have a simple baseline. The challenge is knowing when to break from it. Another approach is the flexible spending strategy. This method adjusts how much you withdraw each year based on how your investments are performing. When the market is strong and your portfolio grows, you take out more. When the market drops, you scale back your spending. The goal is to make your money last by protecting your investments during downturns. This approach works best for people with a lot of discretionary spending. If half of your expenses are for things you can easily cut back on, you have room to adjust. If most of your expenses are fixed costs like housing, insurance, and utilities, this method is harder to use. Imagine a retiree in Florida with a $2 million portfolio. When the market is up, they take extra trips, upgrade their car, and give more to family. When the market is down, they skip the big vacation and delay major purchases. They still cover all essential expenses, but they adjust lifestyle spending. The benefit is flexibility. You can enjoy more in good years while protecting your portfolio in bad years. You also reduce the chance of selling investments at low prices. The challenge is discipline. Cutting back during a market downturn can feel uncomfortable. It can also mean reducing spending right when prices for essentials are rising due to inflation. This strategy also works better for high net worth households. If your fixed expenses are low and you have a large discretionary budget, you can adjust without sacrificing too much comfort. For someone with high debt payments or large fixed costs, it's harder to make meaningful cuts. In that case, the flexible spending strategy might not provide enough protection. The key to making it work is knowing exactly which parts of your budget can change and by how much. If you can bend your spending without breaking your lifestyle, this strategy can help your retirement money last longer. The bucket strategy is one of the most visual and easy to understand methods. It divides your retirement savings into separate buckets for short-term, mid-term, and long-term needs. The first bucket holds enough cash or low-risk investments to cover 2 to 3 years of expenses. This is your short-term bucket. It's designed to be stable and safe, so you don't have to sell investments during a downturn. The second bucket holds moderate risk investments like bonds or balanced funds. It covers expenses for the next 3 to 7 years. This bucket provides some growth while keeping volatility lower than stocks. The third bucket is for long-term growth. It holds your highest risk investments like stocks. The goal is to outpace inflation and grow enough to refill the other buckets over time. When you need income, you start with the short-term bucket. As it runs low, you refill it from the mid-term bucket. The mid-term bucket is then refilled from the long-term bucket when markets are favorable. This structure creates a buffer. If the market drops, you can rely on your short-term and mid-term buckets without selling stocks at a loss. The benefit is psychological as well as financial. You can see exactly where your next few years of income will come from. That makes it easier to stay invested in the long-term bucket without panic selling. The challenge is maintenance. You have to decide when and how to refill the buckets. If the long-term bucket has a bad year, you may hesitate to move money out of it. If you wait too long, you risk running the short-term bucket too low during a market downturn. This method requires some active management and regular rebalancing. It also works best when interest rates are high enough for the short-term bucket to earn a reasonable return. For many retirees, the bucket strategy offers peace of mind. It gives a clear plan for where to pull money from. It also creates time for long-term investments to recover before you need to touch them. The guardrail strategy is a newer method that blends structure with flexibility. It starts with a withdrawal rate, often around 4%, but adds upper and lower limits to guide changes. You set a target withdrawal amount in the first year. Then you define 2 boundaries for your portfolio value. If the portfolio grows past the upper boundary, you increase your withdrawals. If it drops below the lower boundary, you reduce them. For example, with a $1 million portfolio, the upper guardrail might be $1,250,000. The lower guardrail might be $850,000. If the portfolio grows above the upper level, you might raise your withdrawals from 4% to 4.5%. If it falls below the lower level, you might lower them to 3.5%. This approach allows you to enjoy more when markets perform well while protecting your savings during downturns. It also gives you a clear signal for when to adjust, rather than making changes based on emotions. The benefit is balance. You're not locked into a fixed withdrawal forever, and you're not adjusting every year without a plan. The changes are based on clear rules you set in advance. The challenge is that spending cuts can happen at inconvenient times. If the market drops sharply and your portfolio hits the lower guardrail, you may need to cut spending when prices are rising. That can be difficult for retirees who have limited flexibility in their budget. This strategy also requires discipline to follow the rules. It's easy to ignore a guardrail when it means cutting back. It's also tempting to spend too much when the upper guardrail is hit. For retirees who want structure but also want their withdrawals to reflect market performance, the guardrail strategy can be an effective middle ground. It offers a blend of safety and opportunity, provided you are willing to adjust when the signals tell you to. The amount you withdraw each year matters, but where you take the money from can be just as important. Different accounts have different tax treatments. Pulling from the wrong account at the wrong time can cost thousands in unnecessary taxes. Retirees often have a mix of taxable accounts, traditional retirement accounts, and Roth accounts. Each has its own rules. Each impacts your taxes differently. If you withdraw from a traditional IRA or 401k, the entire amount is taxed as ordinary income. If you withdraw from a Roth account, it's tax-free if you meet the requirements. If you sell investments in a taxable brokerage account, you may pay capital gains tax, which is often lower than income tax rates. A smart withdrawal plan coordinates these accounts to keep your tax bill as low as possible. In years when your taxable income is low, you might take more from traditional accounts. In years when your income is high, you might draw more from Roth or taxable accounts. Consider two retirees, each withdrawing $50,000 a year. One takes it all from a traditional IRA. The other splits withdrawals between a traditional IRA, a Roth account, and a taxable account. The second retiree could pay far less in taxes over time, leaving more money invested and growing. Tax efficiency isn't just about the current year. It's about planning across decades. A poorly timed withdrawal can push you into a higher tax bracket, increase Medicare premiums, or affect Social Security taxation. Coordinating your withdrawal sources also helps you weather market swings. If the market drops, you might take income from a more stable account, giving your stock investments time to recover. The most effective retirement income strategies treat withdrawals and tax planning as a single process. They look beyond the withdrawal amount and focus on which accounts to tap and when to keep more of your money working for you. Lowering fixed expenses can make any withdrawal strategy easier to follow. The less you have to spend on non-negotiable costs, the more flexibility you have when markets change. For most retirees, the largest fixed expense is housing. Paying off your mortgage before retirement can free up thousands of dollars each month. That extra room in your budget can be used for travel, hobbies, or simply reducing how much you need to withdraw. Debt reduction has a double benefit. It lowers your monthly spending, and it reduces the risk that you'll be forced to take large withdrawals during a market downturn. Consider two retirees with the same $1 million portfolio and the same lifestyle goals. One has a paid-off home and no debt. The other still has a mortgage and a car payment. The retiree without debt can live on a smaller withdrawal, which helps the portfolio last longer. Lowering fixed expenses also makes flexible strategies more practical. If you can quickly adjust spending without cutting essentials, you can reduce withdrawals during market declines without feeling trapped. Fixed expenses can include more than just debt. Insurance premiums, property taxes, and utility costs all add up. Reviewing these costs before retirement can create significant savings. The more control you have over your outflows, the more confident you can be in your retirement income plan. Your withdrawal strategy works best when it's supported by a lean, manageable set of fixed expenses. No single withdrawal strategy works for everyone. Your choice depends on your goals, your lifestyle, and your comfort with market changes. Some people want steady, predictable income regardless of market performance. Others are willing to adjust spending in exchange for a better chance of preserving or growing their portfolio. Risk tolerance plays a major role. If you worry about market volatility, you may prefer a bucket strategy or a conservative guardrail approach. If you're comfortable with variability, flexible spending might be a better fit. Your lifestyle goals matter too. A couple who wants to travel extensively in the early years of retirement may benefit from a plan that allows higher spending at first, then scales back. A retiree focused on leaving a financial legacy may prioritize lower withdrawals to preserve assets. Knowing your personality can guide your choice. If you like structure and clear rules, the 4% rule or guardrails might be more appealing. If you value adaptability, flexible spending or buckets could fit better. The most important step is aligning your strategy with the way you actually live. A plan that looks good on paper won't work if it forces you into constant stress or frequent course corrections you can't tolerate. Matching your withdrawal approach to your personal habits ensures you can stick with it through good years and bad years. That consistency is what keeps your retirement on track. Building a personal withdrawal plan starts with knowing your true expenses. You need an accurate breakdown of what you spend each month and each year. Separate your spending into fixed and discretionary categories. Fixed costs are essential and unavoidable. Discretionary costs are flexible and can be reduced if needed. Once you know your expenses, compare them to your retirement income sources. This includes pensions, Social Security, annuities, and withdrawals from your portfolio. Choose a withdrawal strategy that fits your level of spending flexibility. If you have low fixed costs, flexible spending or guardrails may work well. If you have high fixed costs, the bucket strategy or a conservative fixed percentage may be safer. Plan your withdrawals with taxes in mind. Coordinate which accounts you draw from each year to keep taxes as low as possible. Use low-income years to convert funds from traditional accounts to Roth accounts. Review your plan every year. Check if your spending has changed. Check if your portfolio value has moved outside your comfort range. Adjust your withdrawals or spending if necessary. Having a personal withdrawal plan means you don't have to make major financial decisions on the fly. It gives you confidence to spend without fear of running out of money. It keeps your retirement focused on living, not worrying. 4 key lessons can make any retirement income plan stronger. First, pay off major debts before you stop working. A paid-off mortgage or car loan can free up cash flow and reduce how much you need to withdraw. Second, keep your spending flexible. When markets fall, being able to reduce withdrawals can protect your savings. Third, diversify your account types. Having taxable, tax-deferred, and tax-free accounts gives you more control over taxes in retirement. Fourth, review your plan regularly. Markets change, expenses shift, and your goals may evolve. Annual check-ins keep your plan aligned with your needs. The right withdrawal strategy is the one that lets you live the life you want without fear of running out of money. It balances the freedom to enjoy today with the security of knowing tomorrow is covered. The passive path is about making intentional choices with your money. It's about creating a retirement you control instead of one controlled by the market. If you take the time to plan, you can spend your retirement focused on living fully, not on worrying about whether your savings will last, like this approach. Share it with someone planning for retirement, and subscribe for more strategies to build lasting financial freedom. As always, feel free to watch the other videos here on the Passive Path for more insights and practical advice. See you in the next video.